Welcome to Financial Accounting Reports, Understanding the Statement of Cash Flows. Some important facts about the Statement of Cash Flows. First, the Statement of Cash Flows is prepared for an economic or business entity. Similar to the income statement, the Statement of Cash Flows is prepared for a period of time, for example, month, quarter, or year. The Statement of Cash Flows includes operating activities, investing activities, and financing activities. The total cash flows plus beginning cash balance is equal to the ending cash balance. We'll take a more careful look at this on the next slide. The statement of cash flows may be prepared using the direct or indirect format. This is just the way the information is presented. The information is the same regardless of the format used. Indirect format is the most common way of preparing a statement of cash flows. To summarize, the cash flows from operating activities plus the cash flows from investing activities plus the cash flows from financing activities is equal to the net change in cash. The net change in cash plus the beginning cash balance is equal to the ending cash balance. It is important that the cash flows are presented on the statement of cash flows in the order that they are listed here: operating, then investing, then financing. Here we have Google, an economic entity, presenting the statement of cash flows for 3 different accounting periods. Here we see that the period of time that Google is presenting is 1 year for each of the time periods presented. We see that Google presents operating activities, investing activities, and financing activities. We see that the net change in cash added to the beginning cash balance is equal to the ending cash balance. Now let's take a look at what is included in each of the 3 areas presented on the statement of cash flows. We'll start with financing activities. Each activity includes inflows and outflows. So we can have cash inflows from financing activities or cash outflows from financing activities. If cash is coming into the business, it's an inflow. If cash is going out of the business, it's an outflow. First, cash received from creditors through long-term and short-term borrowings will be included in the financing section. If we borrow money from creditors, we would have a cash inflow that would be reported in the financing activity section. When we repay the creditors for the borrowings, that would be included in a cash outflow in the financing section. However, interest is not included in the financing section. Cash received from investors or owners is also included in the financing section. Cash paid to investors or the owners is also included in the cash outflow section of the financing activities. This does include dividends. Next, let's take a look at investing activities. Investing activities also has outflows and inflows. We list outflows first here because typically you have a cash outflow before you have an inflow from financing activities. When we pay cash to acquire investments or plant and intangible assets, we have a cash outflow that would be listed in our investing activity section. When we receive cash from selling the investments and plant assets or intangible assets, we would have a cash inflow in our investing activity section. If we loan money to others, that would be listed in our cash outflows from investing activities. And when the borrowers repay us, that would be listed as a cash inflow from investing activities. However, this interest is not included in the investing activity section. Our final section that we'll discuss is operating activities. We have cash inflows and cash outflows from operating activities. We'll discuss cash inflows first. Cash received from customers for sales of goods or services is an operating cash inflow. Cash received for interest or dividends is also an operating cash inflow. And cash received for other operating activities would be included in the cash inflows from operating activities. Cash outflows includes cash paid to suppliers of merchandise and services, cash paid to employees, cash paid for interest, cash paid for income taxes, and cash paid for other operating activities. So let's take a look at how it fits together. We have beginning cash, which is the cash balance at the beginning of the accounting period. We have ending cash, which is the cash balance at the end of the accounting period. The net change in cash from operating, investing, and financing activities plus the beginning cash balance is equal to the ending cash balance. Now we have an example. On December 31st, Sally ordered a pizza from Great Pizza Company. The pizza is immediately delivered to Sally, and she paid for the pizza when it was delivered. So we have pizza being delivered and cash being received. The cash received is what we want to pay careful attention to. So, what is the effect on the statement of cash flows? We received cash on 12/31 from a customer for a product. Cash received for the delivery of a good or service is included in the operating section of the statement of cash flows. Next, we have Great Pizza Company borrowing $10,000 from the bank, and they promised to repay the loan plus 8% interest in 12 months. So cash is being received on 12/31. So how does this affect our statement of cash flows? Cash is received on 12/31 from the bank for a loan. That means we're borrowing money from the bank. When we borrow money, that's reported in the financing section of the statement of cash flows. Next, we have Great Pizza Company paying the bank $10,800 on December 31st, 2012. So $10,000 was to repay the loan, $800 was for interest. So on 12/31, cash is paid, cash is going out. We have a cash outflow. How does this affect our statement of cash flows on 12/31? Cash is paid to the bank. $10,000 is for the loan. $800 is for interest. Repayment of the loan goes in the financing section. So we have a $10,000 cash outflow in financing. Payment of interest goes in our operating section. Next, we have Sally ordering a pizza for a party on New Year's Eve. The owner knows Sally and agreed to send her a bill for the pizza. So on 12/31, the pizza was delivered and the customer promises to pay later. At some point in the future, cash is received. We want to take a look at the financial statement effect on 12/31. The pizza is delivered. The customer promised to pay later. You'll notice that we're not receiving cash on 12/31. If no cash is received, the statement of cash flows is not affected. So we do not have a change in the statement of cash flows for this transaction on 12/31. In review, we know that the statement of cash flows is prepared for an economic or business entity for a period of time. The time period can be a month, quarter, or year. The statement of cash flows includes cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Total cash flows plus the beginning cash balance is equal to the ending cash balance.